Okay, thank you very much, everybody, and welcome to the monetary policy session. We have 3 speakers today, and the first speaker is Djeneba Drame. I hope I pronounced it correctly. And who will present Do Firms React to Monetary Policy and in Developing Countries? Thank you very much.
Thank you, Chair. Hello, everyone. I'm very glad to be here today to present my paper, titled Do Firms React to Monetary Policy in Developing Countries, which is a joint work with Florian Lyon at Ferdi. So in this paper, we analyze the effect of monetary policy on financial constraint, firm financial constraint in developing countries. As we know that the transmission of monetary policy in developing countries remains an open question. Based on theoretical literature, the most effective channel through which monetary policy can affect real economy in those countries is through banks, but this transmission channel is hampered by a limited impact of central banks' decisions on banks' liquidity needs. For example, excess of liquidity. Because of excess of liquidity, low competition, high presence of foreign banks, etc. But also by a limited impact of the bank decisions on macroeconomic activity due to the limited banking development in those countries. So, based on the empirical literature, there is a mixed evidence. The earlier studies using macro time series did not found a robust effect of monetary policy in those countries, but the recent literature using more granular data documents a real effect. But these studies cannot be generalized because it is case studies. And in this paper, the objective, this paper aims to provide a new evidence on the effectiveness of monetary policy in developing countries using firm-level survey data. So what we do and what we found, we compare in this paper perception of financial access for managers surveyed just before and just after a change in monetary policy current. And we found that we document an effect of monetary policy when the policy rate changes significantly, more than 150 basis points. And we also find that the effect is symmetric both for increases and decreases, and is stronger for firms with a prior relationship with a bank. And also we found that the effect is stronger for countries with less liquidity needs and independent central banks. And finally, we show in this paper that monetary policy affects not only perceptions, but also the manager's decision to apply for a loan. So, we made several contributions to the literature on the, yes? Yeah. The company they work for. Yeah. So, as I said, we made several contributions to the literature. So, we provide evidence that combines internal and external validity. And because the recent papers attempted to isolate the effect of monetary policy by exploiting a specific events. But as I said, this paper suffers from low external validity. And also, we focus on the demand side of monetary policy, because a study often focus on surprise side shocks by suppressing demand side changes, where borrower discouragement is a major driver of firms' lack of access to credit in developing countries. And also, we examine the heterogeneity of monetary policy because there is a limited evidence on the differential impact of monetary policy on firms, and also a lack of knowledge for developing countries. So now I'm going to present data that we use and methodology that we use in this paper. So in this paper, we combine hand-collected database on monetary policy changes with firm-level surveys. So for the monetary policy event, which are hand-collected data information on policy rate changes in developing countries. This data come from central bank publications. So we go in each central bank website, we collect the following information, the exact day of the event, change of monetary policy, Also, we collect the direction of change, if it is a hike or a cut. Also, we collect the previous and the new policy rate in order to quantify the magnitude of the change. And for the firm level data, this data came from World Bank Enterprise Survey, which is a firm level survey of representative sample of private firms covering more than 180,000 firms in 154 countries. So in this database, we extract two main variables: managers' perception of finance as an obstacle to their businesses, and also the day of interview. So for our sample, we build a window around an event. It is the change of monetary policy, and we restrict the sample to films survey within a 60-day window before and after monetary policy change. Why we do that? The reason is to isolate the impact of monetary policy by allowing this film to share common macroeconomic conditions. Okay, we additionally drop films where there was an overlap between two monetary policy changes. So a film may only be associated with one event. Okay, so the goal is to clarify the definition of control and treatment groups. Without this restriction, a film can be in both control and treatment groups for two different events. So we end up with a sample of almost 29,000 films from 63 countries and 177A events. So our baseline model is defended with a continuous treatment. Here, high, it is film perception of access to finance as an obstacle to the current operations of the establishment. And in this model, we introduce variable post, which is a dummy. It takes one if the film high is surveyed after the event, and delta IR, it is absolute change of the key policy rate in basis point. And we include other variables as a monetary policy fixed effect, and we control for films characteristic as size, age, sector, property ownership structure, etc. So what we expected, we expect that beta 1 be greater than 0. Why? Because we expect that after a change in monetary policy, film manager will adjust their financial constant perception. And we expect that beta 0 be equals to T0. So our identification strategies assumes that films survive before and after first common macroeconomic condition. It cannot be tested, but we do several robustness check, and these robustness check give us confidence in these assumptions. And also we assume that film are similar in their characteristic, so there is no reason to expect it that they survive designed to be affected by a change in monetary policy. but we perform a balance test that confirms the absence of difference for the observable characteristic of films, except for sole proprietorship. So the main results are we found that a change in monetary policy affects manager perception of credit constraint in developing countries, but the effect occurs only when the rent change is important, substantial, more than 150 basis point. We found a symmetric effect for hikes and cuts. So these three main results can be summarized in this figure. So we can see that in x-axis the change in key policy rent in basis point. So we can see that when the magnitude of the change is substantial, the perception also increase both for hike and kite in the monetary policy changes. And we also see that the effect is symmetric for the both cut and hike in the policy current. So also we found that the effect is most pronounced in the first month after a monetary policy decisions and tends to dissipate thereafter, and we find no anticipation effect. So in this graphic, we look at the effect over time of monetary policy on perception, and in x-axis we have weeks. So we can see that after a change in the policy rate, the perception a change over time. The maximum effect is observed 2 weeks after the event, and after 6 weeks, the effect tends to dissipate. And we didn't find a clear anticipation effect because here there is no trend in the anticipation perception of the films after a change in monetary policy. So we did some robustness check to see the robustness of the main findings. So the first robustness check that we use, it is to use alternative windows ranging from 30 to 90 days, and using these windows, we found that the result remains significant. They didn't change. Also, we use alternative measures of dependent and interest variables. For the dependent variable, you use a dummy instead of continuous, like in Bayesian model. And for interest variables, policy current change, we take the relative change of monetary policy current instead of absolute change. The results are significant, did not change. Also, we take into account the time elapsed since the last event. So, as we see that when the absolute change of money in the current change is important, the effect on the perception is also important. But we find doing this analysis that when the time since the previous event is distant in time, the effect is more important. And also in this robustness checks section, we also use alternative econometric specification. We use the ordered probability model. Our results remain significant. And also we test the dependence of our sample dependence by excluding events with insufficient number of observation. or by excluding country by countries, even do that, our results remain significant. So in the last part of robustness checks, we have tried to destroy our main findings by doing a falsification test, by considering other obstacles. So the idea intention is that monetary policy should only affect the financial constraint obstacle of films and not other obstacle reported by managers. So we didn't find any effect of monetary policy change on other obstacles reported by managers. So also in this paper we analyze the heterogeneity of monetary policy. So the interest of the heterogeneity analysis is to better understand when the monetary policy is more effective in shaping perception. So we transform our baseline model to a triple interaction model. We are more interested by coefficient beta 3. Here in this model, ZIC is the moderator effect of the film I or the country C level. So what we expect that if beta 1 is here, beta 3 is positive if the moderator Z increases the effect of monetary policy. Otherwise, it is negative. So we expect that beta 0 and beta 2 are not expected to be different from 0. So the main result of the heterogeneity analysis are, first of all, from a film level characteristic, we find that less financially constrained films, which are all large, man-owned, and films with a prior relationship with a bank are more sensitive to monetary policy changes. That means that monetary policy may affect the intensive margin, low terms more than the extensive margin, likelihood of getting a loan. And also for control level characteristic heterogeneity analysis, we firstly for the financial system, we find that excess liquidity proxied by remittances reduce the effectiveness of monetary policy in developing countries, but we did not find any significant effect of the level of competition and also the banking development level in those countries. Also, we did not find an effect of the share of foreign on banks on the effectiveness of monetary policy in those countries. Also, in country level characteristic, we analyze the central bank independence, credibility here, by taking the jure measures. We didn't find any effect of central bank independence on the effectiveness of monetary policy. But when we take de facto measures like the turnover rate of central bank governance, we find a significant effect. And in the last part of this paper, we try to answer at the following question: what is about the impact of monetary policy on manager decision? So we run the following model to provide an answer, where here in this model, I is a dummy equals to 1 if a film applied for a loan in year T, and here delta IR is the change in the policy rate in country C from the end of the year T minus 1 to the end of the year T. And in this model, we include control fixed effect, also control film control variables and control variables also. So we find that manager here that column 2 here, which is based on the sample of the baseline model, we found that managers are less likely to apply for a loan after a monetary policy tightening, And the majority here, we can see that it is the effect is very limited, even though significant. So the major limitation of this technique methodology is that we cannot know when a film applied for a loan, if it is before or after a monetary policy change. In conclusion, so in this paper, this paper adopts a new approach to shed light on the effectiveness of monetary policy in developing countries. So we focus on the demand side, potential borrowers, and we examine changes in perception of a limited window around an event. We take advantage of the cross-country nature of the database rather than focusing on a single event. And the main findings are that firms respond to monetary policy in developing countries when policy rate change are sufficiently important, and the effect of monetary policy is metric, and it is stronger for firms with a prior relationship with a bank in countries with an independent central bank. And we also show that the monetary policy have also an effect on firms' behavior, notably their decision to apply for a loan. So beyond our paper, in this paper, our work is first to use high frequency and survey data to analyze the impact of monetary policy in developing countries. So future work could follow this path to better identify the effects of short-term policy in developing countries. Thank you for your attention.
Thank you, Cher. Thanks you, Djeneba, for this dynamic presentation. I read your paper. I'm Fréjus-Ferry from NCA, and I read your paper in which you try to assess how monetary policy affects managers' perception of financial constraints. I found your research well conducted with a lot of findings. And I also found that the topic is relevant for our developing countries, since it is about the effectiveness of monetary policy. You did a lot of checks, robustness checks, heterogeneity tests, and so on, and I really found it interesting. I just have some few comments on the paper. I see that you need, I know that this is a work in progress, so I think that you need to sometime well justified some declaration. For example, you mentioned that in the page, at page 15, I think so, that as is common in event studies, you exclude the period immediately preceding the event, but you didn't mention any previous work. I think that sometimes you need to cite some authors. Some authors. So definitely in at page 9, it's not really clear for me why you didn't control the country fixed effects. I read the parts and it's not really clear to me. Next, at page 14, you consider 4 thresholds. You mention 50, 100, 150, and 200. And you show that managers are more likely to report increased financial constraints following a policy rate increase only when the change is sufficiently large. You found more than 150 basis points. But I'm thinking about, so you consider the threshold is determined, you determine exogenously the threshold, And I'm thinking about what if the real threshold is, for example, less than 150. This is just if you can find a way to determine endogenously the threshold. Okay? Yeah, the threshold. So at the end, you collected some information about monetary policy change, and you mentioned that you collect the information about the precise date of the events. But is it the date of the effectiveness of the policy change or the date of announcements? But because in our countries, sometimes the central bank make the announcements about the policy change or the policy rate change, and few days after the new policy rates apply. So just I think that if your date is about the effective date, maybe there could be some anticipation behavior for managers if the announcement is made some few days before the effectiveness date. So once again, this is a very well researched paper, and I think that yes, you could publish it in a very top journal. Thank you very much.
Thank you very much for this comment. Okay, we need to just justify some affirmations. Okay, we will try to do that. And about okay, why did we control for country effect? It is the second model. In the second model, yeah, because it is. Yeah, in the second model.
Yes. Let me try and see. No, the first one.
Yeah, because we introduce a film fixed effect. We cannot estimate the two fixed effect, because monetary policy fixed effect also control for country fixed effect in our model. So it didn't change. If we introduce, it cannot be estimated. So we, yeah. And also, yes, maybe the threshold effect can be threshold can be less than 100 basis points, but we feel like we wanted to take absolute change like 51, 100, 150 to 200. It is we did not make look at the prices threshold, but it can be interesting to look at in that. And also, we for the date of the announcement or the effective change date, we take the date of announcement. That is when we collect data, we take the date of announcement. But if we don't have the date of announcement, we take the effective date. But in most of the case, we take announcement date. And I think it is all questions. Okay. So, yes.
Thanks for the presentation. I'm wondering if I'm not sure what kind of countries you have. I mean, it looks like a large sample of countries. So I'm wondering if it's possible to look at for all the countries or even just a subset, if there's a difference in the response of firms, depending on expectations, prior expectations of the monetary policy decision. So if, say, the rate change was 100 basis points, but there were expectations of a 50 basis point rate change. So at the moment you have it such that you see that the rate change, that the response depends on just the quantum of the rate change. But I'm wondering if it might also depend on how different the actual rate change was from expectations. Does that make sense?
I didn't get the point.
It's just so if markets or market participants, if the firm was expecting a 50 basis point increase, right, in interest rates, and then a 50 basis point increase happens, it's very different from if you were expecting a 50 basis point rate increase and then interest rates actually increase by 100 basis points.
Okay.
Right? So that's different from if interest rates just increase by 100 basis points. It depends on what you were expecting.
Okay, but how we can analyze this because we don't have such a question about their expectations. So I don't know how we can integrate this.
Maybe building on that, which I think it's a very good point.
Yes.
I mean, there are data, at least cross country, for some countries, maybe not all in your sample, but many of them, in which you have people estimated monetary policy surprises in developing countries. So you can take those surprises, because still what you need is some surprise at the yearly level, and the data are at the yearly level. I can send you the reference. You can take those, and these are kind of surprise, and then kind of resolve her question, which I think it's a good one.
Yes, it is an interesting point. And it can be interesting to look at the monetary policy surprises. We didn't do that, but now actually we are trying to do that, but because it is one of the comments that I get in also another conference. Thank you very much.
Oh, no, thank you very much for your great presentation. And I'm sorry that I wasn't here at the beginning, so I have missed some information related to the paper. I think it was in sub-Saharan African country or in Africa?
No, it is on developing countries around the world.
Oh, around the world. Okay, that's my quick question to see if in your analysis you have seen some distinction between countries that are part of monetary union, like WAEMU or, or CEMAC. I can say it in French, but the name in English will disturb me. So to see that, because some countries that are in monetary union, sometimes they are characterized by stability in terms of prices. Maybe it could be different from managers in this country can be more confident in the monetary policy, than a country that is not in a monetary union, something like that. I'm wondering if you have tried to see if there was difference in perception of firm manager in these two kind of countries,
Okay.
Yeah.
Thank you for your question. We didn't compare the perception of manager from union countries, monetary union countries, and those from non-monetary union countries. But what we did, we analyzed the effect with the triple interaction model to see if to be in monetary union can increase the effectiveness of monetary policy, but we did not find any effect of monetary union. We were expected that maybe when interacting with a monetary union, because firms of these countries can be more confident in monetary policy, and that can enhance the effectiveness of monetary policy, but surprisingly, we didn't find any effect. You're welcome.
one last question. Just a curiosity, in the enterprise survey that you used, are you aware if there is any question on not only on whether they applied for a loan, but also if they were successful in getting a loan? I think that could be, a very interesting thing to study. To see, for example, if a monetary policy easing has made, access to credit easier.
Yes, we did actually this analysis in the last part on the behaviors, and we didn't find a significant effect.
Oh, okay.
Yes.
Thank you.
It is very interesting. Thank you. So thank you very much.
Well, hi again. I'm Fréjus-Ferry Houndoga from UNCIA, Abidjan. And I'm going to present you this work in progress. This is a joint work with two colleagues of mine, Desiree Kanga from IMF and Shalfi from UNCIA. And this paper is entitled "Do Financial Frictions Amplify Commodity Price Shocks in Commodity Exporting Countries? Evidence from Côte d'Ivoire using a DSGE model." So just to give you an overview of commodity states in our countries, commodities are basic goods that are used in commerce, that are interchangeables with other type of goods, like and these commodities includes raw and agricultural materials like cocoa, coffee, cotton, and so on, fuel and energy, mineral and metals. So these products are most often used as inputs in the production of other goods and services. We all know, for example, that petroleum is used in transportation, just to give you an example. So the problem is that all these products are traded on the international market and therefore are subject to the law of supply and demand. And since supply and demand are changeable, we see that all these commodity prices are highly volatile. So I plot here selected commodity price indices from January 1990 to December 2021. And as you can see, there is a lot of volatility in all these indices. And this volatility just reflects the movement in each individual prices. But the problem is that economies of developing countries are strongly based on commodity export. So in our countries, a large part of government revenues is constituted by commodity-linked revenues like taxes, royalties, and profits. According to the United Nations Conference on Trade and Development, and out of 189 countries around the world during the period 2013 and 2017, 54% are commodity dependent, meaning that at least 60% of their exports is consumed by commodities. And the problem is we can see that more of commodity or countries in developing and sub-Saharan African countries are more dependent on commodities. As a consequence, economic cycles of these countries are strongly correlated with the cycles of commodity prices. And as I showed before, these prices are highly volatile. So this creates some constraints on the budget constraints, but also this can affect all the agents that are involved in these commodities. In fact, commodities are not only a source of funding for the conduct of government policies. These are sometimes important source of income for most private households. Also, many firms are involved in their production, processing, and exportation. And we show in an earlier paper that price volatility can even affect the financial sector, then we think that any movement in commodity prices can affect simultaneously all sectors in the economy. So that the better way to appreciate the real effects of volatility or a shock on a commodity price on the economy will be by adopting a general equilibrium approach. Unfortunately, most of the work on the subject adopt a partial equilibrium strategy. So they often evaluate the impact of price fluctuations on some key macroeconomic variables like quality of institutions, economic growth, and so on. From the other side, Bernanke and his co-authors showed in 1999 that credit market imperfections are able to amplify and propagate shocks to the economy in a quantitatively significant way. And this extra amplification helps to understand how relatively small shocks as a change in real interest rates, as she showed earlier, a small average change in firm costs, a small movement in commodity prices, how these relatively small shocks can have a large real effect. And this is known in the literature as the financial accelerator. Putting all these elements together, this paper aims to address or to answer this question: how does commodity price volatility spread throughout the economy in exporting countries, and what is the role of the financial frictions in this propagation? Our objective is to analyze how commodity price volatility spread throughout the economy, and to access the role of financial sector in the propagation of these shocks. To do that, we developed a dynamic stochastic general equilibrium model. These class of models have micro foundations based on optimization of and rationality of economic agent behavior. And these models are able to integrate frictions, inefficiencies, price sickness, making them structural, and integrating Lucas criticism. So we base our methodology on the work, the model developed by Cristiano and Al in the new Keynesian model framework. And since DSGE model starts with the setting of the framework, we consider in this paper a small open economy with 4 groups of agents that are households, firms, banks, government and central banks, and the rest of the world. This is this graph shows the different interaction between all the group of agents in the economy. And we can see, for example, in this model, I don't want to be too technical, but just to give you an overview. In the economy, we assume, for example, that there is a continuum of households that own firms, financial assets, they consume goods and services, and derive a part of their income from labor to private sector. They aim to maximize their lifetime expected discount utility, which is equation 1, under the budget constraints, that is explained in equation 2. Okay, and we optimize these kinds of relations to find a steady state of the economy. From the banking sector, because I'm talking about financial frictions, we consider in our framework that banks are responsible of collecting savings from households as in form of bank deposits, and then distribute these savings to agents in need of financing. And this, in our case, this is the production sector. The problem is that we assume that there are imperfections either in the relationship between bankers and households, and also between bankers and enterprises. Because when bankers collect deposits from households, we assume that they can choose to divert a part of the funds for their own consumption. By doing that, there is a risk that the bankers will not be able to pay depositors back. And this, but only the bankers know the risk. Okay, the households do not know that risk. But from the other side, we also assume that when bankers collect deposits from households, they need to finance the firms, and they choose to finance firms with or projects that seems to them relevant. Okay, they chose to finance relevant investment projects. But how do they know that an investment is relevant? They need to make decision, but the investor knows something about his investment project. So there is a kind of asymmetric information that creates frictions in the financial sector, and as we show earlier, these imperfections are able to amplify price. Yes. Yes. Also. Okay. So here, yeah. Sorry. Yeah, thank you for your question. Yeah, in this paper, we assume that this is a fixed part of the deposit. Yes, and we calibrate so that the part is very small to make the banker at any time capable to face his obligations. Yeah, so we back to the model. In the model, we can see interactions between all agents. And finally, from the production side, we have also a lot of firms. We have capital goods producers and entrepreneurs. And the most important is that we consider in this framework that there are two different sectors. The commodity production sector and the non-commodity goods sector. In our case, we consider cocoa sector and the non-cocoa sector. And both commodity and non-commodity goods are combined into an aggregate output for the overall economy. And this output is either used for domestic consumption or either exported abroad. And the final goods used in the economy is made up goods imported abroad and a part of domestic production. So, in line with our research question, we developed a simplified version of this model. The first model that I show, we call it the full model. And we developed a reduced form of this model in which we assume that there is no financial frictions, either in the relationship between household and bankers or between bankers and entrepreneurs. And our aim is to compare the relation of these two models following a shock on commodity prices. And we choose to, our model remain general, but we choose to calibrate it for a country, which is Côte d'Ivoire. Why Côte d'Ivoire? Côte d'Ivoire, as like a lot of developing countries, depend heavily on the export of commodities, and the main one is cocoa. You know that Côte d'Ivoire is the top producer of cocoa in the world. And for example, in 1917, cocoa accounts for almost 25% of the GDP. Just to let you know how dependent is Côte d'Ivoire economy on cocoa, and this is the case for a lot of countries in our economies. So, for this reason, we think that Côte d'Ivoire remain a best student to know how commodity prices shocks affect the economy and what is the role of the financial sector in this propagation. So, We calibrate the model for the Côte d'Ivoire. So what do you mean calibration consists of determining the set of parameters as we could say in my previous slides. We can see a lot of equations with parameters, and we determine the set of parameters values in order to have the best possible fits between the behavior of the theoretical model and the object of the study. And we do this by using either the literature or our knowledge of the Ivorian economy. Then we verify if the model have the best dynamic behavior by simulating 3 conventional shocks that are productivity shock, fiscal policy shock, and monetary policy shocks. And we show that both model reacts very well following these 3 shocks. And these shocks highlight the presence of the financial sector acceleration in our model. And then we simulate a positive shock on commodity price, which is here is cocoa price. So the question is, how does the economy react whenever there is a sudden rise in cocoa price? Here are the impulse response functions following a positive shocks, and the blue line is for the full model, the model with financial frictions, and the green one is the reduced form, the model without any financial frictions. So we can see, a positive shocks on cocoa price have the effect to increase the overall output, YT. We also can see that there is a kind of a rise also in the private consumption, which we interpret like an increase of household well-being. But what do we learn from all these graphs? The first thing is that the policy shock had the direct impact of increasing cocoa producer prices and then boosting the overall GDP. And the GDP, the overall GDP, the rise in the GDP generates the classic effects of a supply shock, including a fall in prices. As you can see here, we can see that the inflation rates decrease following the increase of cocoa price. This is a classic effect of a supply shock. We can also notice an improvement in household well-being through an increase in private consumptions. But these effects are observed and in both model. You can see that in both reduced and full model, we have the same effects. But the magnitude of the increase induced by the positive shock on the GDP seems to be greater in the reduced model than in the full model. You see here that the green charts remain just above the blue one. But the blue one, I said that this is the full model. Also, the shock-induced increase in private consumption seems to be smaller in the full model than in the reduced one. We interpret these results saying that the benefits of cocoa price booms could be reduced in the presence of financial frictions. Just to sum up, we tried in this paper to examine the role of financial frictions in the propagation of commodity price shocks in commodity exporting countries, and we developed a DSGE model to do that with financial frictions. The model remain general, can be estimated or calibrated for any commodity exporting countries, but we chose to estimate it for the Ivorian economy. We do not find any evidence of financial friction or financial accelerator in the model for the case of Côte d'Ivoire. There is no evidence that financial frictions amplify negative commodity price shocks in commodity in Côte d'Ivoire. Just for the case of Côte d'Ivoire, maybe if the model is calibrated or estimated for another exporting countries, there could be a kind of financial accelerator. But the model suggests that financial frictions would prevent the country from fully benefiting from commodity price booms. The key lesson that we can learn from this model is that despite the strong link between resource abundance and GDP, commodity price volatility is detrimental to all economic agents within the economy, and the financial frictions would prevent the country or commodity exporting countries to fully benefit from commodity price booms. These are our findings right now about this research project that we are conducting right now, and I want to thank you for attending this session. Thank you very much.
Okay, so thank you very much for this presentation. I really enjoyed reading the paper. I think that it focuses on on two important issues for many sub-Saharan African countries, which is commodity price fluctuations and financial frictions, more broadly, access to credit. And I think the paper does a very good job, like in combining these two effects in a coherent framework, and also in analyzing the the aggregate macroeconomic consequences of the interplay of these two issues. And I think that the use of a DSGE model is really spot on, because it allows to, really assess the impact on many different variables, and also in analyzing the general equilibrium effects. I think that two potential caveats I see about this analysis that could be addressed either in this but also in subsequent research would be is one, the assumption of homogeneity in cocoa producers. Like, presumably, I would expect that, larger producers face less severe constraints when it comes to access to credit, financial frictions, as opposed to smaller producers. So I think that some sort of heterogeneity in cocoa producers could be interesting to study. Another issue that is related to this is households heterogeneity, and the model is quite standard in assuming that all households are Ricardian, so essentially everybody can hold assets, can trade assets, can also resort to debt, and this also allow households to withstand shocks quite well. But we know that many households in this type of countries do not have access to credit, so some sort of financial frictions from the household side could also be interesting. And one simple way is to assume that there is a fraction of the households that do not have at all access to financial markets, the so-called rule of thumb consumers, and they simply, period by period, they consume all their income. And I think that this could be one possible, and I would say also straightforward extension for the paper. But I see also the paper as part of a broader research agenda that could also look at more type of empirical analysis. And by doing like a quick search on Google, I saw that there are some surveys to cocoa producers, precisely in Côte d'Ivoire, but also in Ghana, and so these surveys surveys have questions on whether producers have access to credit, whether they have access to insurance, whether the production for a specific point in time, and so on and so forth. So one could somehow link this survey. I mean, I don't know exactly the details and whether the survey is long enough to do this analysis, but one could investigate whether the surveys could be used, in conjunction to information about the commodity price cycle, for example, when commodity price went up or went down, and see how the characteristics of these producers have affected effects. And so this may be also useful from a policy perspective, because it may give an indication that, for example, subsidies to help this smaller producer get insurance, may help them withstand shocks in a better way. I'm just making that up. So I think that, this is the fact of having coupled, financial constraints with the commodity price shocks for, I think it's a very, very important theme, and I can see, more research coming up out of that. Thank you very much. Any questions? Yeah, I think there are some questions. Oh, sorry.
Yeah, hi. Thanks for the really interesting paper. I was trying to think, you motivated it really with the volatility of commodity prices. And when you're doing the simulations, it's like a single shock, either a price increase or a price decrease. And I was wondering if you have any ideas about how to maybe extend the simulations to model a change in volatility, an increase in volatility, and compare that high volatility to low volatility. It might be challenging, but something maybe to think about in future.
Okay, thank you. Yes, I use the volatility and shocks in the model as the same way, but yes, you're definitely right. Yeah, and we are thinking about that because we have a new version of this paper in which we are investigating absolutely. We are doing the model with two different countries. This is an extension of this model, and yes, we are doing something about country facing high volatility and those with low volatility. Yeah, thank you, and thank you too for all your comments. Yes, thank you. There is no questions, but I mentioned that all you did recommendation for improvement of the quality of the paper. That's fine. Thank you very much. Yeah.
Sorry, I might have missed it, but do you assume that the impact of a price boom and then a crash in commodity prices, that they're symmetric?
Yeah, that is a great question. We normally, a positive and negative shock are different, but in the model we show that the effects of either positive or negative shocks are symmetric. I didn't mention this in the presentation, but this is the result that we got. That's why I say that we didn't fund any financial accelerator mechanism in the model. So we were assuming that if there is a kind of financial accelerator, financial frictions may probably amplify negative shocks. But we didn't find any evidence that negative shocks are amplified in the case of Côte d'Ivoire. Okay, we found a symmetric effects. Okay, I think there is no more questions. So thank you once again.
Okay, so in the last presentation for this session is about monetary policy under natural disaster shocks. And I'm Giovanni Melina. I come from the research department of the IMF. And this paper is a joint work with Alessandro Cantelmo, Nikos Fotouros, and Chris Papagiorgio. And as usual, these are the views of the authors and not necessarily those of the IMF. Okay, let's start with some motivation. And here we look at disaster-prone countries. And first of all, I would like to clarify what we mean by disaster-prone countries. We take the frequency of climate-related disasters, and we focus on emerging and developing economies. And the reason why we do that is because in these countries, the really natural disasters may have very sizable effect on the aggregate macroeconomy, and to the point that it become relevant for central banks, for monetary authorities. And here in this table, we present the first quartile of the distribution of the frequency of these climate-related natural disasters. And as you can see here in this column, we have predominantly either small island states or low-income countries. So these are countries that are either small geographically, so when a natural disaster hits, it affects the whole country, the whole economy, or it's countries that have a small economy. So when a natural disaster hits, it affects a large fraction of the economy, of GDP. And to put things in perspective, for example, let's have a look at the change in GDP growth in Belize. Belize experienced in two subsequent years, in 2001 and 2002, a very strong storms. They were cyclones that reduced GDP growth relative to the previous year by about 8%. And to put things in perspective, in the United States, when in the 70s there was the oil crisis, GDP growth declined by about 6% in 1974 and 1975. So this tells us that a cyclone in Belize has a relative impact that is comparable or even stronger than the impact that a major macroeconomic shock has in an advanced economy. Natural disasters already disproportionately impact developing countries and are projected to become even more frequent and to have a greater intensity. So in our view, these are not. It is not only interesting to study this issue of monetary policy in disaster-prone developing countries per se, but also they represent a good laboratory to study this issue also in a forward-looking manner. So when also more advanced economies will face more frequent and more intense natural disaster shocks because of climate change. So why do we care about monetary policy? Obviously, monetary policy cannot be a substitute for adaptation policies. So for policies that increase a country's resilience to climate-related shocks. And this is why also the literature has focused less on the relation between monetary policy and natural disasters, and it has focused more on fiscal policy as a tool to build this resilience. And my co-authors and I have a paper precisely on this. But at the same time, as we will show in this paper, getting the monetary policy right also makes a difference from the point of welfare. And importantly, having monetary policy set in the wrong way or in a suboptimal way may make a sizable impact when it comes to welfare. In addition, it is also interesting to note that many of these countries face important policy dilemmas, because many of them either peg their currency or they have a managed float, they have an exchange rate anchor, so they don't have full monetary policy independence. And also, disaster realizations often behave as a supply shock, because they decrease output and they increase inflation. So there is a trade-off between stabilizing, the economy or stabilizing inflation. So central banks face this dilemma. So we focus on, in this paper, we focus on two research questions. One question is more a positive question, so analyzing how monetary policy is set in disaster-prone countries. And to answer this question, we use some stylized facts that make use of a narrative analysis of IMF staff reports. And then the second question is more of a normative question. And so what should be the optimal monetary policy rule? And to answer this question, we use a business cycle model with monetary policy and natural disaster shocks. This is a quite standard model. And then we analyze a wide array of monetary policy rules to compare welfare outcomes. So I will skip the related literature for time constraint. I mean, there is a growing literature now on the effect of natural disaster, both in empirical and theoretical literature, fiscal policy, some on monetary policy. All the details are in the paper. Some highlights from the narrative analysis. These are box plots of three main macroeconomic variables, around the occurrence of natural disaster shocks. And we can see that in a vast majority of cases, in the aftermath of a disaster, there is a decline in GDP growth. In many cases, there is an increase in inflation, although the evidence is less clear. And then there is a wide range of outcomes when it comes to real money growth, so that we cannot say much about it. And this is also why we should do more analysis about this issue. So we conduct this narrative analysis of IMF staff reports, and we look at cases in which natural disasters were of a size that caused at least damages for 1% of GDP. We do that because we want the disaster to be large enough to matter from a point of view of monetary policy. Our final sample consists of 34 disaster years that occurred in 16 disaster-prone countries, and the time range is from 1999 to 2017. And this table represents our whole sample of disasters, and you can see that damages really vary. I mean, and in some cases, these are huge damages as a percent of GDP. And, the disaster type, the most frequent disaster type that enters in our sample is storms. And the literature really finds that storms are some of the most impactful climate-related disasters. So how do we analyze all this information from staff reports? We have a total of 12 questions that are relevant for monetary policy, and we answer these questions by reading the staff report. And so, and then we document this these answers in a very long appendix of the paper. And we report also quotes that corroborate the answer to a specific question. So, for example, to go back to Hurricane Iris that hit Belize in 2001, one of our questions is, did GDP contract or slow down in the aftermath of the disaster? We say yes, and the quote that support this answer is taken directly from the staff report. And we do that for each and every question. And then, here it's obviously just a summary of these results. For example, one of the questions is, but if did monetary policy have a chance, in our sample? Because if we have all cases in which monetary policy was heavily constrained because the economy was dollarized or there was a hard back and so on and so forth, monetary policy couldn't have done much. But actually, we see that in a majority of cases, in our case, we are dealing with disasters that occurred in countries where at that point in time, there was either an independent monetary policy or a soft peg, so there was some room for maneuver for monetary policy. And also, we see that in a majority of cases, the monetary policy stance changed in the aftermath of monetary policy. And when changed, the monetary policy stance was tightened in most cases, but also accommodated in a sizable minority of cases. So this means that really there is no, clear-cut pattern when it comes to the reaction of monetary policy in the aftermath of disasters. And this also highlights the trade-offs that these countries are facing, because in some cases they prioritized stabilizing inflations. In some other cases, they might have prioritized, boosting or sustaining growth. Okay, and when it comes to tools, we have that the most frequent tool that was used was the interest rate. We also shed some light on what the IMF advice has been in these cases, and surprise, surprise, whenever authorities tighten monetary policy, IMF staff agreed with tightening. They did not object. But also, it must be said that they did not object also in a sizable minority of cases in which monetary policy was accommodated. So this means that even from the point of view of policy experts, there is no consensus on what should be done. So this is a further motivation for the model analysis that we perform in this paper, and the model we use, as I anticipated, is quite standard. So I will not go through each and every detail of the model, and I will instead focus on the extensions to this model. So the extension the first extension is the fact that we allow TFP to be impacted by natural disaster shocks, but relative to the literature, we allow both the permanent and the transitory component of the TFP process to be impacted by natural disasters. And we have a parameter here, parameter omega, that represents the weight, the proportion of the impact on transitory versus permanent effect. And this is because we want to link it especially to the empirical literature, because in the empirical literature there is a big debate on whether natural disaster shocks have a permanent or a transitory effect on the level of TFP. Some people even argue that TFP overshoots after some time, after the occurrence of a disaster, appealing to some Schumpeterian theory of creative destruction. And in some other cases, people find exactly the opposite result, that the effect on the level of TFP is permanent. We remain a little bit agnostic, and so we essentially allow for both, and then we experiment for more extreme scenarios as well. And the second extension is adding the small open economy angle in the model, because the countries that we're dealing with are indeed small open economy, in many cases small island states that also rely a lot on tourism. And for this reason, we add this red component here, represent a direct impact that a disaster shock has on exports, as on the demand of exports. And there is quite a bit of empirical literature that actually finds, for example, that when a cyclone hits, a country in the Caribbean, for example, there is a lot of cancellations. People don't want to go there, and so there is an effect, a direct effect on export that it's important to capture. And the third extension is not really an extension, is the fact that we allow for a wide range of monetary policy rules. So on one hand, we have flexible inflation targeting, which is a rule that allows for a temporary departure of inflation from target. Strict inflation targeting that stabilizes inflation right away. Then we have a peg that instead stabilizes the exchange rate. A traditional Taylor rule, so the interest rate that responds to output, so inflation and output. An exchange rate augmented Taylor rule that adds also a concern for the exchange rate, and this is a typical case for many of the countries that we look at, where there is, although there may be inflation targeting, there is also a concern for the exchange rate. And the last one is called the nominal GDP targeting, which is a more theoretical construct. I mean, it has been, discussed in the theoretical literature, but it has not really been applied in practice. How am I doing with time? Oh, it's okay. Okay. And then we add a number of shocks. We have TFP shock, disaster risk shock, disaster realization, foreign inflation, foreign interest rate, and foreign demand. And we calibrate these shocks to match empirical evidence. I'll skip the calibration, and here I show basically the impulse response function to a disaster realization. So this is just a one-off disaster. What happens to macroeconomic variable? We see that output goes down, consumption also initially goes down, investment goes up because there is a destruction of capital that needs to be rebuilt. And export, for the reasons that I explain, decreases, and also import initially decrease, but the net effect on net export is negative. In order to reconstruct the loss of capital, also net foreign asset decrease, because the country has to borrow in order to replenish capital. And then importantly, domestic good inflation goes down because of the decline in the demand for domestic goods, but because there is an exchange rate depreciation, CPI inflation increases. And given that in this case in this slide we are assuming flexible inflation targeting, monetary policy tightened in order to stabilize inflation. And then, so the interest rate increases, and eventually inflation is brought back to target. So, as I said, we analyze many alternative monetary policy rules. Here, for example, I show three: the baseline, which is a flexible inflation targeting, and vis-a-vis strict inflation targeting, and a hard peg. So in the case of a hard peg, for example, the exchange rate is stabilized right away, and this comes at the expense of a stronger decline in output, because the exchange rate has shock absorbing effects that are not, are neutralized here. For example, any strict inflation targeting, on the other hand, stabilizes inflation right away, and so the monetary policy rate increases much more in this case. But these again are one-off shocks. In order to say something on the monetary policy regime that a country should adopt, what we do is we simulate the model for a large number of periods, and we subject the model not only to the one-off disaster shock, but also to all the other shocks that I mentioned before. And then what we do, we compute welfare across many different types of monetary policy rules. And what we see is that welfare is the largest under flexible inflation targeting, and in all other cases, welfare is smaller. Households' welfare is smaller, and in fact, in the most extreme right column in this table, we report consumption equivalent welfare losses relative to the flexible inflation targeting regime, and we see here that losses from not having a flexible inflation targeting are quite sizable. Then one may say, okay, but here we used very specific monetary policy rules. We picked parameter values to calibrate these monetary policy rules. So, this is a fair point. So what we do is we explore the domain of these parameters, and here we report the welfare level as a function of monetary policy rule parameters. And for example, in the middle chart, on the x-axis, we have the responsiveness to output, and we can see that consistently responding to output triggers a decline in welfare. The same can be said for responsiveness to the exchange rate, while when we look at the responsiveness to inflation, we see that welfare is maximized at a relatively small value of the responsiveness parameter, which is about 1.1. And what does it mean? It means, on one hand, that focusing on inflation stabilization is the welfare optimal rule in these cases, but at the same time that a very strong, a very tight monetary policy stance would be counterproductive. It would be welfare detrimental. So, essentially, in plain English, when natural disaster hits, the optimal rule is focusing on inflation so that inflation expectations remain anchored, but at the same time allowing for temporary departures of inflation from target. We do a lot of robustness checks. I'm not going to present those. In the paper, we experiment with many different parameter values, with changes in model assumptions, and from a quantitative perspective, results change, but the bottom line of the analysis remains unchanged. So regardless of what we tried, flexible inflation targeting remains the welfare optimal regime. So to conclude, I showed that natural disaster shocks are major determinants of macroeconomic outcomes in disaster-prone countries, that our narrative analysis point to the fact that central banks do react to these shocks, but there are no clear-cut patterns on what the reaction normally is. We use a standard business cycle model with the monetary policy and natural disaster shocks, and we calibrate it in a way that is compatible with the stylized facts we produce. And in this model, what we find is that flexible inflation targeting is the welfare optimal regime in these cases. Thank you very much.
Thank you, Melina, for your great presentation. So I really enjoyed to read your paper on the monetary policy in disaster-prone developing countries. So my discussion will be around 3 points. I will start with a summary of the paper, and following, I will make some comments, general comments on the paper, and some questions. So, in this paper, you have two research questions which drive this objective, a general objective, which is to analyze how monetary policy is set after a disaster in disaster from emerging and developing countries, and also to determine the optimal policy role in those countries. So for that, you employ two approaches, natural approach in order to answer to the first research questions. So you use then a sample of 34 disaster years in 16 disaster-prone countries from 1999 to 2017. And for the second question of research, you use a small open economy New Keynesian model with disaster shocks. So the main findings of this paper is that, from the narrative approach, that natural disasters are typically followed by a decline in output and often by an increase in inflations. And you find also that independent central banks change their monetary policy extends in the aftermath of disasters. And most of the time, the monetary policy extent was a tight monetary policy to master the inflations. And from the theoretical model simulation, you found that under flexible CPI inflation targeting, that welfare is maximized by keeping the interest rate response at the lowest level needed to keep inflation expectations anchored while minimizing the impact of real activity. And you found also that both hard peak and strict inflation targeting magnify the GDP loss to an extent. So the general comment is that I really found this paper very interesting on the monetary policy in emerging and developing countries, disaster-prone countries, and I found that the paper is well written and easy to read, even the theoretical part that I am not used to. And I liked the combination of a narrative approach and theoretical approach. And maybe some suggestions, it is minor, that I see you focus mainly on damage based on GDP. So why not consider other indicators such as the number of victims and the percentage of national area affected by disaster? And I see that in the for the theoretical model, you use many robustness checks. It will be also interesting to see that if the result for a narrative approach will remain unchanged if you consider other indicators instead of the GDP loss. And also, for your main findings about the optimal policy, I think that it is not enough discussed. You have to discuss the result more. And also, in the conclusion part, I think you it can be beneficial to elaborate this part by including policy recommendation for makers in those countries. So I have maybe 4 questions. Why did you stop the analysis at 2007? Was it because there were no disaster in those countries after this date? And also, have you tried to include countries with less than 1% GDP loss? That can be like a robustness check. Also, your model is based on which definition of a small economy? Because I had the difficulty to get the point. I don't know if it is geographically number of population or level of income level. And also, can we expect that the monetary policy reaction should be similar between emerging and low-income countries? If not, how the results can be extrapolated? Thank you. That's all.
Yeah, no, thank you very much. These are very important questions. Okay, so first of all, on the criterion to pick, to classify disasters, and the reason why we focus on the size of disaster as a percent of GDP is because we want disasters that are relevant for the monetary policy authority. So typically there is a correlation between, the size of damages and, for example, number of victims and so on and so forth. So, I would expect that other metrics would probably capture a list of disaster that is similar to the one that we capture, but we wanted to focus on disasters that are, relevant from the monetary policy authority. From the main policy recommendation really is, the fact that flexible inflation targeting turns out to be the welfare optimal monetary policy rule. And so essentially this means that in the face of climate-related disasters, the monetary authority should resist the temptation of, boosting GDP, through monetary policy. But instead they should focus on price stability. So but at the same time, what we find is that the extent to which they have to focus on price stability is also moderate in the sense that they should not, exacerbate the economic downturn by having a very tight monetary policy. So that's the thing. Focus on your job, which is inflation stabilization, but not overdo it, and let somebody else, like the Ministry of Finance, deal with measures, for example, to sustain economic activity, to facilitate the reconstruction, and so on and so forth. So that is probably our main policy recommendation. The reason why we stopped at 2017 is that this paper has been going on, for a while. So, when we did the analysis, it was, I think we started the analysis in 2018 or 19. So 2017 was probably the last available observation. Why don't we look at less than 1% of GDP is, because for the narrative analysis, we look at staff report of the IMF, right? And we need the disasters that are large enough for the report, to give a chance to the report to talk about it, because many of these countries face disasters every year. Like if you take Caribbean countries or small island states in the Pacific, they at least have like some small cyclone, some small storm, every single year. And so it doesn't even make it in the report when these disasters are too small. So that's why we want disasters that are, sizable, to be commented on. And then, emerging versus low-income countries. I think, actually this is a good point, because one potential caveat of our results is the implicit assumption that monetary policy is credible. No, because we have, a New Keynesian model with the Taylor rule. So this assumes that monetary policy is credible, while in low-income, in some at least, but many low-income countries, monetary policy is not credible. So this can be a strong assumption in some cases. And in those cases, maybe a stronger reaction of the monetary policy authority could be warranted, just to signal that the central bank is serious about inflation stabilization, and to make sure that inflation expectations remain anchored. While in more developed countries that have a history of credible monetary policy, they can afford to they can bank on that credibility to let inflation deviate a little bit more from the target. That's a good point. Thank you.
I just have a clarification question, I guess. You know how you classify the different monetary policy regimes, like strict inflation targeting or more flexible? How do you do that? Because I can imagine that there might be a monetary authority that says it's maybe strict inflation targeting or flexible inflation targeting, but actually really cares about exchange rate movements or exchange rate volatility.
Yeah, we look at, there are some classifications that are available, and they look at, de facto and de jure monetary policy regimes, and so we rely on those. But also, given that this is a characteristic that may change over time, and so we look at a sample that spans like almost 20 years. So what we do is we rely on the IMF staff report itself. So essentially, this is one of the questions that we have in our questionnaire that we answer by looking at the staff report, which normally, elaborates also on the monetary policy regime and on the exchange rate regime.
Thank you. I thought this was a really, really interesting paper. I have two questions. The first question on your narrative analysis. I just wanted to find out if you have any idea if countries that had implemented a tightening of monetary policy in response to a first natural disaster changed stances in subsequent natural disasters, or if tightening monetary policy persisted. And then my second question on the optimal policy rule, do you have any, speculation on how this flexible inflation targeting would change potentially in response to a supply shock that is not climate change related? So if like commodity prices increased, for example, and that was the supply shock, do you have any idea which rule would prevail in that instance? Thank you.
On whether the tightening, your question, I think it was either referring whether they changed the stance after they tightened, right? Or whether in a subsequent disaster, if they behaved in a different way, right? That's what you, no, that we do. We could do that, because we have some countries that have had more than one disasters in the sample. So we could see whether there was a different behavior, whether they learned from the experience of a previous disaster. That's actually something that we could try to see. Yeah. And on your second, the speculation, the issue is that here the natural disaster shock hits in many different ways, right? Because it affects exports, it affects, it destroys capital, and also it affects TFP. So speculating on what may be the welfare outcome with a different type of shock, I don't think it's safe for me to do it. I should try and do it. Yeah.
Thank you, Giovanni, for your presentation. I have a comment. I'm afraid if I miss something, I can see that your in the second model, your impulse response functions, I can see some variable diverge.
Oh, okay.
Is that I'm afraid if you miss,
okay, sorry.
the steady state or there is another steady state, something like that.
So in this model, there is long-term growth. There is a trend. So all variables like GDP, consumption, investment, they have a common trend, and they grow over time. So what we report in the impulse response functions is the level of the variable. And so this is why you see a trend. Another way to report results would be to report deviations from the trend, which is something that we could also do. But the reason why you see this trend is because it is an assumption of the model.
Sorry. Is it a multiple country model, or you put all countries together and build a single country model? Because I didn't catch the point very well.
It is a single country model that has a small open economy feature. So it basically is, export and import goods. It has a balance of payment and so on and so forth, but it is a single country model. So the assumption is that this country trades with the rest of the world, but we don't model the rest of the world. So what happens like to foreign demand and foreign inflation and so on and so forth, this is exogenous to the model. Okay, so if there are no more questions, thank you very much for coming to this session. Thank you.